Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing Lyn Alden of Lyn Alden Investment Strategy. How you doing today, Lyn?
I'm good. How are you?
I'm doing well. You're one of my favorite macro analysts, and you're one of the GOATs. I think you're one of the GOATs, one of the greatest of all time. That may be offensive to some folks in this space, but at the very least, you're one of the GOATs of our generation, assuming that you're a millennial like I am.
I am a millennial, yeah, but I don't know about GOAT, but I do my best, so I appreciate it.
Yes. So I've been a subscriber to your service and your newsletter, I think since about 2020. So I'm always catching the latest articles that you're putting out, interviews you're putting out. And recently you put out a public newsletter on the debasement trade. And so I want to start with the Fed and tie that into the debasement trade. And so in late October, the Fed announced the end of quantitative tightening on December 1st. They've done that. And the Fed also said it would reinvest about $15 billion into T-bills using proceeds from maturing mortgage-backed securities. And since then, we've also seen the Fed inject about $40 billion into the repo market. So they're buying these short-dated treasuries, but they're careful not to call it QE, and they're labeling it as reserve management purchases instead. And from your perspective, is this functionally QE, and does this signal a meaningful shift in monetary policy?
Yeah, good question. I would say it's functionally very similar to QE. My kind of stance is that it is money printing. It's very similar to QE. They are, and I even said ahead of time they would not call it QE when they got to balance sheet expansion because they're not focusing on buying duration, and they're not doing it for the purpose of economic stimulation. But a lot of that is semantics, not all of it, but a lot of that is semantics. So I consider it very adjacent to QE. And for the most part, this was kind of telegraphed in advance. The New York Fed even, they put out their annual reports about this kind of status of their balance sheet and expectations. And they thought that by around 2025, 2026, it would eventually bottom and then start going up roughly in line with nominal GDP. And also, they even predicted that they would keep accumulating in treasuries at that point, but they would keep letting mortgage-backed securities mature off of their balance sheet, kind of in an attempt to normalize, so that they're not really influencing the housing market as they did after the global financial crisis and during COVID. And so it is a pretty momentous shift, I would say. It's not something that really matters on a week-to-week basis too much. But it does matter over months when you go from kind of a structurally declining base liquidity situation, quantitative tightening, to a flat and then to a gradually expanding balance sheet. Before the global financial crisis, the Fed's balance sheet did very gradually expand over time, and it wasn't really quantitative easing. It was just kind of base layer gradual money printing. And now it's kind of the same thing going forward, with the key difference that because of all these post-GFC regulations, banks have much higher kind of liquidity and capital requirements, and so there's kind of a higher percentage of the balance sheet relative to the size of the economy, and now it's structurally growing roughly in line with the economy, and that's a key difference between fiat systems and something like gold or Bitcoin, which is that if there's too many IOUs for hard money, it's the IOUs that have to collapse down to the actual base layer. Whereas in fiat, when there's too many IOUs relative to the base layer, they just can toggle the base layer up and down, and that's what's happening here.
Yeah. So I'm curious. So in your article, your recent article, you mentioned that you see it as a gradual print, and I know that some people believe that it's going to be larger than that. Like the Fed is going to open the floodgates, and almost similar to COVID, and so. And that's one of the reasons why I like reading your work, because you do kind of, you do bring like more of a balanced approach and try to weigh out all the different outcomes. Obviously, if there's some type of crisis or black swan event or and such, I believe that the Fed would open the floodgates. But how do you see this gradual printing interacting with the markets over the coming years?
Right. So I agree with you that the Fed would pretty much do whatever they need to. And I think for the most part, most scenarios don't point to a really big print. Of course, there are potential for war, or potential for some sort of other crisis that could trigger something bigger. But my kind of high percentage base case is a more gradual print. And I think that basically they'll do kind of whatever minimums or maybe slightly above minimum is needed to keep, one, the treasury market liquid and functioning, and two, kind of the core repo market, all the interbank lending stuff, kind of these really core markets. Because the Fed doesn't mind too much if the stock market goes down 20%. They don't really mind too much, if gold goes up 20% or more. A lot of investors might think they care that much, and they do watch those. But the things they can't really let break for any amount of time are the government bond market and the adjacent markets like repo that use those treasuries as collateral for liquidity. And so I do think we're shifting toward a more gradual environment. And I think this is characteristics of fiscal dominance. Basically, the Fed will be supporting the bond market. They won't be calling it that, but that's effectively what they're doing when they're, selling mortgage-backed securities and buying treasuries, even when we have above target inflation. And even when I was, when the Fed was making their kind of balance sheet prediction, they weren't really talking about inflation. Over the past couple of years, what I've been saying that roughly around this time is when we'd see balance sheet expansion. I said it'd be regardless of what the headline CPI is. They're going to go back to balance sheet increases because they're going to keep the bond market liquid and they're going to keep repo functioning no matter what CPI is printing. They can do other measures to try to tame inflation where they can. But I think that basically they're in a position now where they're responding to these core markets. Now, next year, when we likely have a different Fed chair and we have a slightly different, board of governors, we could see a little bit more dovishness out of the Fed, a little bit more kind of close connection between the central bank and the government, from what is normally supposed to be somewhat of an arm's length relationship. But I still don't think it'll be like a massive shift in policy. I think we'll see more gradual changes. And there's a bunch of different levers they can pull, and they've already started pulling some of them. So, for example, they've adjusted supplementary leverage ratio regulations, which is like a word salad, but basically it's a very slight deregulation for banks that effectively lets them hold a little bit more treasuries within any given level of liquidity and capital requirements. And there are some proposals within the Fed and elsewhere to further ease those, specifically basically to let big banks and others kind of just hold more treasuries. And they already have kind of provisions to reduce risk around treasuries. So basically, they can either provide liquidity with their own balance sheet, is what they do when they create base reserves to buy treasuries, or they can let fractional reserve banks take that on their balance sheet as well. So a couple different levers together can put them in a pretty accommodating stance without being kind of hyper dovish in some sense.
Yeah. So how dovish does the Fed need to be to? So one, we have this agenda to reshore manufacturing as well as to bring production, extraction of minerals, and all of those different things that cost billions, hundreds of billions, maybe even trillions to even bring back online and such. And so I'm kind of wondering, like, okay, where we're going to get this money from, and so I'm curious if you have any perspective there. Obviously, the tariff revenue is under scrutiny by the Supreme Court right now. President Trump said we brought in trillions, which, I mean, I don't know if he was just saying that or if he really believes that or what, but just curious in your perspective there.
Yeah, so before the tariffs, we were structurally running something like $2 trillion deficits. Back of the envelope math is we spend $7 trillion and we take in $5 trillion and we have this, $2 trillion shortfall. The tariffs are bringing something like $400 billion annualized. That number can change over time. We're looking at something like 20% deficit reduction in the form of effectively a tax increase, which, as you pointed out, is being currently kind of looked into by the Supreme Court. There were lawsuits against the policies, not the idea that tariffs are illegal, but the idea that the president can just use emergency powers to bypass Congress and just do kind of basically a tax increase of any scale for any length on any country indefinitely. So that's being challenged. It might not make the tariffs fully go away, but if the Supreme Court does rule a certain direction, it could meaningfully reduce that 400 billion annualized figure. which is, it's a material figure. So, $400 billion is meaningful, but again, when we're talking about $2 trillion deficits, it's just one variable among many. And then it potentially does slow things down. So sometimes you can raise revenue with a tax, but then that can weigh on part of the economy. And then with a lag, you can get actually reduced economic activity and reduced tax revenue elsewhere. So it's not even clear that it's a straight up $400 billion injection into the federal coffers. But regardless, I think that where the money's going to come from, partially, I'm very slow to think most of this is going to happen. In a strategic sense, some of it can happen. Like, for example, rare earths. That's not really a big number figure so much. Whereas something, reshoring a meaningful part of the industrial base, now that's $1 trillion problem. And if you look at the numbers so far this year, I mean, industrial production is roughly flat. Manufacturing PMIs are roughly flat. Manufacturing employment is flat to even slightly down this year. And I think this was a multi-decade problem in the making, kind of tied to structural things like Triffin's dilemma and our reserve currency. They're very hard to resolve. They're impossible to resolve without making certain trade-offs, which so far no presidential administration wants to make, or even acknowledges that they exist really. And so I think that's going to be a very slow process. Right now, most of the fiscal deficits go more toward kind of the insurance and defense situation. So they go towards Social Security, Medicare, military spending, veterans benefits, and interest on the debt. That's by far where most of the deficit spending goes. And that does help certain sectors and kind of broad swaths of the economy kind of run hot in the nominal sense, even as it squeezes other parts of the economy. So on average, we have this very kind of K-shaped recovery, or a very two-speed economy, where if generally speaking, if you're older or wealthier, you're doing pretty okay now, not uniformly, but statistically. Whereas if you're younger or poorer, if you're a young family trying to buy a home, and you're not really on the side of fiscal spending, but you are on the kind of the wrong side of higher interest rates and higher mortgage rates, partially fueled by that fiscal spending, you're not doing great, generally speaking, right now. So I think that where the money's going to come from is that the Fed's going to accommodate the bond market where it has to. But then other than that, we're probably in this more moderate environment where we're not going to get, probably these huge $1 trillion programs for a while. But the things is still kind of run above baseline. Now, there still is time, but between now and the midterms, they might try to pass something kind of big. $500 billion, $1 trillion. In the numbers, because of all the inflated numbers, those aren't even giant numbers anymore. But we could see something like that. Once you get to midterms, depending on how they go, you could have a more polarized political situation. And so I just think it's a challenging from a fiscal side. I think that we're going to continue to run it hot, but my base case is not super hot unless I start to see a specific piece of legislation gain kind of tremendous momentum.
George and his team, a 16-year VRIC employee building some of their largest mining operations on the planet. We started a drill campaign, from the drill campaign moving into a full engineering report and study. We came out with our pre-feasibility study in 2021, and it showed a really impressive economic case for advancing the project. We'll have final definitive feasibility out in December of this year. So in the space of 4 years, fully engineered, fully permitted. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
Okay, so a couple things to that point. So one is we have all of these huge AI tech companies. They're pledging, multi-billions into data centers and such. And so I'm curious in how does that impact this updating our grids and things of that nature. And then there's also been some talk about electricity costs increasing for certain populations across the United States due to data centers. And then I'm curious in your perspective on the fourth turning. So I interviewed Neil Howe a while ago, and he mentioned that natural resources would be one of the biggest sectors to invest in coming out of the fourth turning. And my thoughts around it are, okay, we have a big crisis, and then we got to cut spending significantly. I mean, that could probably be the only. I'm trying to think of a situation where some of these promises, like Social Security, Medicare, and pensions, and all of these promises that the government can't afford, could be cut. And I'm thinking like, okay, maybe it's when that crisis occurs or whatnot. And so, just curious if you have any take there.
Yeah, good set of questions. I mean, some of those questions themselves are like a whole podcast of potential
Yeah, yeah,
answers.
for sure.
I think, I mean, with the data center thing, yeah, right now there's obviously very big capex. Combined with the fiscal deficits I just mentioned, the AI capex is kind of the other main pillar of the economy. So you have anything that's kind of on the right side of fiscal deficits or AI capex is doing pretty good, and most of the other industries are kind of mid to weak on the other side of that. And with AI capex, it's funny because it kind of introduces the problem that many people incorrectly thought about Bitcoin miners years ago. They worried that Bitcoin miners come in, drive up electricity prices, waste energy, and things like that. But Bitcoin miners, because they're so hyper competitive, because they're literally competing over a commodity, and something like 80% of their expenses are electricity. They have to fight over cheap electricity, which mostly means stranded electricity. So they either go out, to the middle of nowhere and find stranded natural gas wells and, that are being flared and try to use that instead, or they try to use electricity at the times of the day when it's overabundant and then shut off when it's in peak cost mode. So Bitcoin miners kind of have to go away from population centers and peak times. They don't really have a choice. Whereas AI data centers, more of their spending is on capex than electricity, and they can afford to kind of compete with consumers on electricity. So they actually can, and also they care about high uptime, unlike Bitcoin miners. So they don't want to shut off if there's a brownout. They care about latency, so to some extent they don't want to be too far from population centers. They got some flexibility, but they don't want to be in the middle of nowhere in a way that a Bitcoin miner just needs Starlink and it can be anywhere. It can be in the middle of the ocean, and so that actually does present some problems to the grid and to kind of consumer electricity prices potentially. I don't view it as an insurmountable problem. I just think it's going to be a messy multi-year building process to update the grid. Many of the components are made in China. It's not easy to reshore those. Often even to reshore those, you need to import things from China to be able to make the facilities that could make them here. So it's like a multi-layered problem. There's also not in my backyard-ism, NIMBYism, where and that's also a problem with the rare earths and other things where there could be things that you could technically do, and people say we want it in the country, we just don't want it near me. It could have environmental impacts or eyesore impacts, and people just say I want that somewhere else, and things can get caught in red tape for months and years. So I think it's more like a ton of moderate problems rather than one big problem. But I do think that's an ongoing issue. And how to power them. And natural gas and nuclear, I think, are kind of the main ways to do that longer term. So it's a fascinating area. I also think that we are going to see eventually a drop off in capex, just because while I do think that AI is of course very real, businesses and people use it today, and I think we'll continue to use it even more. There could be localized bubbles where spending it's kind of pulled forward. It's projected to be more profitable than people think, and then it has to kind of go through a shakeout, and then do the next leg up. So I don't think it'll be a straight line. As far as the fourth turning goes, yeah, I do think we're in the fourth turning, and those are generally associated with sovereign debt bubbles, basically, kind of big rotations in debt and currency. Potentially kind of a shakeout in laws and norms that a country goes through, and kind of the reformation of the social contract, sometimes for better, sometimes for worse. And so I do think we're going through that, and either during it or on the other side of it. I am pretty bullish on most commodities, and especially I think that what we just mentioned about the Fed kind of shifting to kind of persistent balance sheet increases. While it's not like a light switch that matters in a given week, really, I do think that sets the stage for a kind of a moderately weaker dollar, Maybe or maybe not the dollar index, because that's primarily a big chunk of that is the euro, and I'm not very bullish on the euro. But when we look at the dollar compared to kind of somewhat credible emerging markets, I think those can get kind of a breather here, because in general we're going to be facilitating dollar liquidity. And generally speaking, when you have a weaker dollar, it's pretty good for emerging markets, and that's where the marginal demand for energy is, and a lot of other commodities. Places that have a lot of their energy and commodities needs met already. They go up and down pretty slow in terms of their changes in commodity consumption, whereas a developing country where people's needs are not anywhere near met, as things turn up a little bit, they generally increase their energy and commodity consumption more materially from a lower base, but with a high population. So I do generally think that once we kind of get through this like rough patch here, I'm pretty bullish on energy, commodities, producers on a case by case basis.
Got it. Okay. And so thinking about this fiscal dominance and currency risk, so Ray Dalio had put out a piece about the Fed stimulating into a bubble. And historically, when central banks prioritize backstopping the government deficits over managing inflation, it can often accelerate currency devaluation. And so I'm thinking about fiscal dominance and the Fed. Obviously, the government is the fiscal side. The Fed is the monetary side. And right now, the fiscal side is dominating in policy and such. And so I'm just curious, what are the implications for the dollar and real assets over the medium and long term?
Yeah, so whenever sovereign economies get into this position of very high debt, especially if the debt's denominated in their own currency, they rarely default or reduce expenses, kind of the nominal sense. They usually default through purchasing power loss. And so basically the government has a handful of choices. They can try to trim Social Security, Defense, Medicare, which are very unpopular. And so there's not really kind of a mandate for that by the public or by Congress. They'd even have to probably go more structural. Like in order to fix healthcare, you have to kind of fix food. Which people don't want to. So it's a whole rabbit hole, a whole bunch of things that to resolve, and maybe at some point we'll get meaningful cuts to those, but I don't think anywhere in the near future. And then the other lever to default is to default through purchasing power on existing obligations, or diminish some of those ongoing obligations with kind of purchasing power loss as well. And so I do think that they're going to continue to run hot. I think that the Fed will never allow the bond market to just go illiquid and default. I think they'll do what they have to keep it supported regardless of what inflation's doing. They'll try to shift the blame around when inflation happens, what's causing it, kind of like how during COVID they were like, oh, it's not the money printing, it's supply chain issues, or it's XYZ. And then even after all that gets resolved, all the price levels are persistently higher for the most part, except for very specific bottlenecks like oil and stuff. But the broad price levels are higher because it actually really was money printing. And I think we'll see a similar environment going forward. So I think it'll be kind of growing dissatisfaction, growing political polarization, both in the United States and in large swaths of Europe, because they're in kind of a similar dynamic, different in some ways. And I think this goes on and on and on until there's kind of a more decisive change, which literally could be in like the 2030s. It's hard to predict the sequence of political things because like certain things can kind of come out of left field, or they can slowly break and crack and then kind of fail all at once, and you have a big shift. So I try not to predict that specific thing, but basically mechanically and quantifiably, this can go on well into the 2030s, not without consequence, but without breaking entirely. Meaning that inflation keeps kind of being sticky to the upside. You have a very two-speed economy, where some people think, oh, the economy's fine, the nominal numbers look good, and other people are like, right now, consumer sentiment is near record lows, even though the stock market's near record highs. We haven't seen a decoupling of this magnitude in 40 years, and it's largely because they're both right in some sense. And if you're on the wrong side of that, it feels awful, and that's partially what fuels the polarization of the public, of politicians, of culture.
Yeah, for sure. So in this newsletter about the debasement trade that you wrote, I mean, you highlighted that the debasement trade has been going on for like 5 decades, and you just you just mentioned the nominal highs and like some of the assets and such. And so I'm curious in how investors should be thinking about their assets, because assets will appear to be performing well in dollar terms in this environment, but they're quietly losing purchasing power when measured against real assets like gold. And we see that with the S&P to gold ratio as well. And so I'm curious in your thoughts on how investors should be thinking about their assets when they're increasing nominally, but in terms of purchasing power, they're not really increasing much at all.
Right. So I think this is a case where the extremes can inform the means, which is to say that if you look at how assets perform in emerging markets that have currency crises, that gives you kind of a directional sense of what can happen, which is you'll have an emerging market, the money supply is growing very quickly. They're in a period of kind of economic weakness, which shows up more like stagflation for them because of the amount of money printing that's happening. And you'll have an environment where their stocks as denominated in their local currency are doing great, even though those companies are struggling in many cases. And yet when you look at them in dollar terms or gold terms, they're doing quite poor. And so when a developed market goes to something similar, so fiscal dominance is similar to what emerging markets go through, just a less extreme version. So you have developed markets in fiscal dominance. They start displaying some emerging market-like characteristics. And so you can have a situation where the stocks look like they're doing okay. The stocks aren't doing particularly poorly when it's denominated in the local currency. But when you go up to the apex predator of like the hard monies, like gold, for example, they're not doing great compared to gold. Even going back decades, stocks are down in gold terms compared to the bubble peak in 2000. By some metrics, that was kind of peak America. Like that was kind of when we had the highest labor participation. That was kind of our peak demographics. That was kind of before we started. We've always been some degree political polarized, but that was kind of before the really kind of widening political polarization started to happen. Before these like forever wars ramped up. Before we kind of got the rise, temporarily of Europe and now China. Kind of competing with the U.S. At scale, and so the stock market never got back to those highs in gold. 25 years later. Now maybe one day they will, and then also in the past several years we're kind of rolling over again in gold terms or in silver terms, and this is exactly what you expect to see in something like an emerging market, which is to say that stock market's doing fine in dollar terms. But it's pretty weak in either gold terms or silver terms, and that's considering how low people are looking at that decoupling between the stock market and consumer sentiment. When we look at this chart, that's exactly what you expect to see when you have weak consumer sentiment. So stocks rolling over relative to hard money, and I think that's actually a pretty accurate reflection of what's happening.
Yeah. I'm glad you mentioned that because I wanted to bring this chart up. So we see like in the dot-com bubble, the S&P, it took about 5 ounces of gold to buy a share of the S&P. And then, it came down during that gold bull run to about almost 3/4 of an ounce of gold to buy a share of the S&P. And then we reached a lower high. And so just curious, could we see us come back to this level, or do you think like it's kind of baked in the cake that this is going to continue to go down in real terms to an asset like gold?
So my expectation is flat to down on a multi-year basis going into, say, the 2030s. I think we'll eventually get to another kind of local low and maybe start climbing again from there. I don't really expect to get back to those highs anytime in any sort of investable time horizon. Now, to be fair to that chart, if you like, that doesn't include dividends. So over the course of that very long, ultra long-term chart, if you held stocks, you did outperform gold over a very, very, very long period of time. not from the dot-com bubble peak, but from many other points on that chart. If you go back 30, 40, 50, 60, 70, 80 years, sufficient long time, stocks with dividends reinvested can outperform gold. The problem now is that stocks are so highly valued and the dividend yield is tiny. And so even with the dividend, stocks are kind of still rolling over relative to gold, which is generally expected when you don't have the kind of core growth that the U.S. had in, say, the second half of the 20th century. And if you look at many other, of course, stock markets, they've not done as well as the U.S. market. So they've generally underperformed gold by even more. So while I am hesitant about the kind of the currently temporarily overbought status of gold and silver, it's becoming an increasingly popular trade. So the contrarian in me is always a little bit wary. I do think that the story remains structural, and that when you compare risks of, say, the U.S. stock market to gold, both and silver both have risks. All of them have risks. But I still think 5 years from now we probably do see another low in stocks relative to precious metals. My guess.
Okay, got it. So within the gold investing community, there's been growing discussion about Tether increasing its exposure to gold. They've taken significant positions in several royalty and streaming companies, a couple of them that regularly appear at Rick Rule's symposium. And so I'm curious, what's kind of your interpretation of these moves, and do you see this as part of the broader debasement trade that you've been writing about for years?
Well, I think partially. I mean, they obviously they've got a pretty powerful income stream because stablecoins, for the most part, don't pay a yield, especially theirs. But they earn interest on the assets they hold backing those stablecoins. So that they earn billions of interest. They put some of it into Bitcoin. They put some of it into gold. They make venture investments, private equity investments. So they buy company equity that they like or that they view as having some sort of strategic relevance to their operations. They also, I mean, in addition to operating a dollar stablecoin, they do have effectively a gold-backed stablecoin. They have Tether Gold. And so it makes sense that they'd want surpluses in some of these types of assets. And so I think that makes sense. I mean, they're earning dollars, and then they're wanting to figure out where to put that into harder assets. So between a combination of gold, Bitcoin, and adjacent things like either mining operations for those things or streaming for those things, or things that are just entirely different, like certain just companies that they view as relevant or likely to appreciate, I think that makes sense.
Yeah. So, correct me if I'm wrong, but Tether mostly had its exposure to U.S. Treasuries and bonds, and I'm curious. You've been writing about the bond bear market for a number of years, and obviously, you have this dynamic of stablecoin legislation and such coming out, and so for me, I'm thinking okay, Tether is investing in harder assets. Could they be moving this way because they know that the bond market is typically gonna lose out or something? And so I don't know, just curious if you have any thoughts there.
Well, I think we want to separate two parts of this business. So one is because they have assets and liabilities. So the liabilities, kind of like how a bank, their liabilities are the deposits for customers. And then they have assets. They have loans and treasuries and securities and all these things. And Tether, in some senses like that, which is their liabilities are any all these stable coins can be exchanged for dollars. So they have all these liabilities, and then they have assets backing the liabilities. And they for the most part it's things like short duration treasuries. And so they have to have enough assets to back up and meet redemptions when they happen. But then the second side of it is that because they're getting a profit, they're earning interest on their assets, but they're not really paying out interest on their liabilities, and their operations are pretty inexpensive to run. They're making it a pretty big profit, and then they have their own balance sheet where they can where are they going to put their surpluses, right? So they can put a little bit of a surplus in dollars, but anyone knows that if you just hold dollars in treasuries, you're going to get devalued over the long run. So then they have a question of where do we want to put our extra value? Like any company can face a similar question. You can pay it out to the owners of the business in the form of a dividend, Or you can just accumulate things on the balance sheet that you expect to do reasonably well. So and if it's a public company, they can buy back their own shares, kind of increase owners' kind of per share, kind of metric of the company. Or in this case, you can accumulate assets. You can accumulate gold. You can accumulate Bitcoin. You can accumulate equity in other companies, and that makes sense because for the amount that they have to back up their liabilities, they want those assets to be relatively correlated to those liabilities. So a T-bill is a very correlated to a dollar stablecoin. That's kind of the main purpose. So they keep a lot of that in those similar assets. But for then your company equity, your surplus, that's when you have a little bit more leeway to invest in things that have some degree of volatility or uncertainty to them, things that can go up and down. Because they're not one-for-one backing assets with that part of the balance sheet, so they can accumulate things that they personally view to be likely to appreciate.
Okay, yeah, appreciate you explaining that because there's a lot of discussion about that in the gold community, and now you have this dynamic of stable coins. Some people are like, what the heck is a stable coin? And you have this technology increasing within the gold sector when you think about tokenized gold and such. And so it's definitely interesting. So thinking about Bitcoin, so I want to touch on Bitcoin. I think it would be a disservice not to. So recently there's been a lot of discussion about the Bitcoin to gold ratio. Since Bitcoin's inception, that ratio has reached as high as roughly like 38 ounces of gold to buy one Bitcoin, and has recently come down to about 20 ounces. So early in Bitcoin's life, gold was obviously going through a prolonged bear market, but in recent years, gold has clearly emerged from that phase. And after Bitcoin's last blow off top, that ratio fell to as low as about 9 ounces of gold to one Bitcoin. And so some gold investors are pointing to this like as a victory, like, okay, it's set in stone. This is going to like turn around and Bitcoin's going to zero and such. And history suggests, recent history suggests that these ratios can turn quickly and often violently. And so I'm curious in how you're thinking about the Bitcoin to gold ratio today, especially in the context of like, the possibility of a sharp reversal.
Yeah, so I'm long-term bullish on both gold and Bitcoin, and have been for many years, and long both. A lot of people do phrase it as that competition. I'm generally not in that camp. I think that they serve kind of different purposes. I mean, some of their purposes do overlap. I mean, they're both a type of kind of money with a very slow-growing supply to it that has certain properties. But other than that, I think they serve pretty different purposes. Gold's obviously the incumbent. It's a much larger asset. Partially why the Bitcoin to gold ratio has done so well is Bitcoin's been in kind of a stagnant stage for especially the past year or so, whereas gold has had one of the more tremendous years on record for such a large asset. And so over the kind of the Bitcoin's history, it's made a series of higher highs and higher lows relative to gold. But since 2021 or so, it's been in this more kind of choppy holding pattern. Because as you pointed out, gold has finally kind of emerged from more of a structural bear market that it was in for quite a while. These things can reverse pretty quickly. Generally speaking, when gold is absolutely ripping compared to gold, people are like, why does anyone own gold? Gold's going to get killed. It's all about Bitcoin now. And then when Bitcoin's having trouble, it's the opposite. People are like, oh, Bitcoin's a Ponzi, sell Bitcoin. Gold's kind of reasserting itself. I tend to fade extremes in both of these. I think both of them have long-term structural stories behind them. Now, obviously, like an elemental metal is more foundational in the sense that it's always going to be worth something. Whereas Bitcoin, it's 16, 17 years old. It's being adopted. It's got that technology component to it. It's got to continue to pass various tests along the way to be adopted. But then it has, that comes with more upside potential. In exchange for all this volatility and some degree of uncertainty, investors that bet on it and end up being right have historically done very well over long stretches of time. So I think, from an investor perspective, you try to understand both. You try to understand what one can do and what the other one can't do, and vice versa. And then you weight them according to your conviction level, according to your volatility, kind of preferences. And so the way I kind of treat it is if you take a portfolio of stocks and bonds, you say, well, bonds are not going to be great, so let's replace a big chunk of that with gold. That's what I've been doing. And then you say, well, equities, some of them are great, some are not. So I'll replace a slice of equities with Bitcoin, which is kind of a similar volatility profile in exchange for historically outperforming most equities, other than maybe the Nvidias of the world. And so far, that's a strategy that I continue to like to do. And of course, one of the advantages, unlike equities, unlike bonds, gold and Bitcoin can both be bearer assets. They don't have to be. I mean, someone can hold a gold ETF or a gold-backed, token. They can hold a Bitcoin and ETF if they want, or with a custodian. But they both have the option where an investor can directly hold gold and Bitcoin in their own custody, so no one can move them except for them, other than a security breach of some sort. And that gives certain advantages, especially in a world of forced turnings and fiscal dominance and currency problems. It's nice to have assets, especially liquid assets, that you can unilaterally control.
Yeah, for sure. I mean, in Bitcoin's recent performance, me personally, I've been averaging in and buying a little bit. I couldn't justify really buying at 125,000 or whatnot, especially since I bought down to the lows of the last cycle and such. And so, I own a little bit of Bitcoin, but also do it with risk management. So I know it's a younger asset, and I own a lot more gold than I have Bitcoin, gold and silver. I have more conviction around those two assets, but I do have a fair understanding of Bitcoin, and I've been buying a little bit in the recent weakness, and so we'll see how it plays out. We're gonna have some folks that are like, "Oh, you sold out" or whatever, but I do whatever the hell I want with my money. So we'll see what happens. But so I do want to pivot to silver, and so if I'm recalling correctly, there was an interview that you did years ago where you were asked a hypothetical question. And if I'm recalling correctly, you were asked if you were to go into a coma for several years and then wake up, which asset would you want to have owned during that time? And I believe you said silver. And this just came to memory recently, and I think Lyn Alden said silver in that interview, and I can't even remember which interview it was. It was a number of years ago. You've done a lot of them, but fast forward to today. With silver hovering around $65 to $66 an ounce, how are you thinking about silver now compared to? I believe when you did this interview, it's like maybe 4 years ago or something like that. And so silver's obviously performed well since then. And so, just curious in your perspective there, and what do you think is in the future for silver?
Yeah, good question. I believe I recall that, and I think the reasoning at the time was while I'm my strategy is some degree of diversification. So it's not like buy everything, but it still has certain pockets of conviction, but then it's spread that conviction around to some extent. So I tend to diversify. But the question was, if I could just have one and I couldn't touch it for many years, like due to a coma or being stuck on an island or something, what would I pick? And the thought process there is, okay, probably in that time frame, Bitcoin outperforms, but there's a non-zero chance that it just gets severely impaired in some way because it's a technology that's still in kind of the bootstrapping phase. So I don't necessarily want to put all my eggs in one basket there. And precious metals, it's like, okay, well, you might not hit a home run, but you're not going to go to zero. And you can have them in some degree of custody compared to equities. And between the two, I viewed silver as more undervalued, and also having many applications in the tech industry as well. So it's kind of a hybrid industrial and precious metal. And so it's funny. I had gold, silver, and platinum slices in my portfolio, and gold was doing quite well for a while. But I'm kind of looking at the silver and platinum ones, like, you guys going to do anything? And finally, kind of all at once, they start kind of breaking out.
Yeah.
So I am enjoying the silver ride finally. Like I said before, the contrarian in me gets nervous. When I see people on Twitter saying, okay, $60 silver, $61 silver, $62 silver. We kind of see the same thing in Bitcoin where it's like, and it's like, okay, 100,000 Bitcoin, and someone's like 101,000 Bitcoin, 102,000 Bitcoin. When we start to see counting in social media on these kind of new higher price levels, it shows where sentiment is. So I would not be surprised to see a correction in silver. I don't know if it's a very volatile metal. I don't try to trade it too much. I just try to fade extremes. So I wouldn't personally be buying more right now. I'm not selling the physical silver I have. In a portfolio sense, I kind of do rebalancing where I think that it makes sense. And so kind of near-term cautious on silver whenever we break the current momentum streak, so I never get in the way of a momentum run. But if you do start to see kind of a crest in it, I would be nervous for a little while. But I don't view gold or silver as overvalued in the recent enthusiasm. I think that they were both undervalued, and to some extent they've caught up to more reasonable valuations. And so I think a lot of the move is maybe done. But like I said before, I think if we look back 5 years from now, will U.S. stocks as an index have outperformed gold and silver? My guess is probably not. And so I still think they're contenders for a portfolio, especially because they have the added bonus that you can hold them in custody. And so I try to lean in and lean out from where there's extremes, but I still like those metals.
Yeah, I think I may be labeled as like a silver moon boy or something because I just see like the triple digits in the cards as a possibility, especially due to like the amount of deficits in the mines for the last 4 or 5 years. And then also it being a byproduct of mining other metals and the increased demand for solar and many other technologies and such.
Yeah.
And so I've been thinking about it, just like silver could. I used to think it was crazy, to some folks saying triple digit silver, and I'm just like, yeah, you're tripping. I
Now
remember
it's less than a double. Yeah, less than a double gets you there. So.
yeah, for sure. I actually remember there was an episode I did with Rick Rule a while ago, and I just told him, I said, man, I'm getting out of silver. Like, I'm out of this thing. It's too volatile. It's not doing anything. I'm just going straight to gold. And then I ended up having to reposition over time, after I got over my emotional rant. But, I could see triple digit silver. And so, I'm kind of wondering right now if the move that has happened, obviously there's some momentum behind it. But I'm kind of wondering, like, okay, is this a repricing because the metal has been like the most undervalued, one of the most undervalued commodities for a long time? We look at the gold to silver ratio. I think right now it's at in the 60s. It's been as low as 30, and so I was kind of curious about that and or whatnot. Do you think silver could be triple digits in the future?
So I do, and I think this was a combination of one, a repricing. But two, repricings tend to overshoot. Whenever there's kind of mean reversion, you rarely get back to the mean. You often overshoot the mean, either to upside or downside. And so I think we're kind of around a reasonable price level for it. But that doesn't mean you can't overshoot it. And even in say gold silver terms, I think the current ratios do make sense. I don't really expect to get back to the kind of the very lows in the gold silver. I mean, anything's possible, but especially temporarily. But I wouldn't bet on it. Another challenging thing is like, especially for something like a double, it's not even that impressive anymore. So if someone owns $60 silver and they expect it to go to 120, that's only a double, which is nice. But there's also a possibility that it could get cut to 40 at some point. So it is it's less asymmetric than when silver was like $20 an ounce or even lower. So I don't love I view it as a more symmetrical trade now, where I would not be shocked literally if it goes to 100 next year or it goes to 40 next year. Neither would be shocking to me. So I'm personally pricing the risk accordingly, where I'm still long silver. And I'm kind of just reducing my forward expectations of it. Well, not really bearish per se, but it's saying, okay, well, a lot of my prior thesis has finally, I mean, it took a while, but it finally played out. And so doesn't mean it can't overshoot, but it's kind of already met my thesis. And because I expect fiscal dominance to continue for 5, 10 plus years, I think especially nominally, a lot of assets can keep going higher, not in a straight line. So that it's just a pocket. It's one of the things. It's a slice that I was leading into, and now that it's done really well, I'm maybe leaning out of it a little bit, but still letting it ride because I don't really want to get in the way of a precious metals bull market.
I'm curious of your perspective on this. So obviously the we have the big banks, Goldman Sachs, J.P. Morgan. Morgan Stanley's chief investment officer came out and said, cut the 60-40, go 60-20-20, 20% to gold. And then, now you have these institutional investors and such looking at silver and gold outperforming the S&P and Nvidia and Google and some of these other high name stocks, quality names. And so, I'm kind of wondering, there's some data out there that's like, okay, well, we haven't really seen much of the retail, much of the larger crowd of money coming into these markets yet. And so, I'm kind of wondering, like, okay, I don't know if we're at a euphoric phase yet, in terms of like how many investors are still into the S&P and such. The S&P to gold ratio is still falling over and such. And so curious if you have any thoughts on, that.
So I wouldn't say that we're as euphoric as 2011. The only time I ever sold physical precious metals was 2011. I was very concerned with the sentiment at the time, and I didn't know that would be roughly the top. I just thought that this environment is very euphoric. This has been a more quiet bull run, and I think that partially that's because in 2011, that was after the global financial crisis. Then there was the initial rounds of QE. The stock market was still well off its highs. It was at that point it was off its lows too, but it was off its highs. So precious metals were kind of the strongest bull market in town, and also Bitcoin was tiny back then. So that was kind of the star of the show. Whereas now, while you have precious metals doing very well, it's also been a good several years for the stock market. Even though obviously there's some recent turbulence, but it's been a very strong stock market environment. So it's not like gold and silver has been the only place in town. So many retail investors are like, well, I'm into chip stocks and I'm into AI and I'm into all this other stuff. So there's kind of been a spectrum that fractures that enthusiasm, which I think has prevented it from getting to the levels that you saw in 2011. Now, if stocks roll over and precious metals keep going, maybe that's where you get that true euphoria. And that's where I'd be more acutely bearish than I am now. Whereas now I'm kind of like more symmetrical, where I think the asymmetry of the situation is less enthuses me less than it did years ago, because I see upside and downside risks. But I'm not in the phase where I'm like super concerned in a way that I was in 2011, because it's just one of many strong markets. And so, I agree with you that there's no kind of extreme euphoria in the precious metal space, at least from my opinion.
Yeah, for sure. Appreciate that. So just going down the chain to unloved assets, hated assets and such. We've seen some of these hated assets like turn around, like lithium. Platinum's doubled where it was, in the last couple of years. Silver, obviously. But one asset that investors aren't really positioning themselves in is in oil. And so it's been out of favor for quite some time. Recession fears have lingered over the sector almost like a dark cloud. And there's recurrent talk about an oil glut. And we've seen recent signals of like 1 ounce of silver buying more than a barrel of oil. And so you've been positioned in oil companies for some years, including like midstream names and such. And investors like Rick Rule, the Bill Bonners, and some of these other like respected voices in this particular resource sector have been actively allocating to the sector. And so just given the sentiment, the valuations, the macro backdrop, how are you thinking about oil right now?
Yeah, good question. I think I've been long a bunch of things. Gold and silver have surprised me to the upside, pleasant surprise. Oil's been a little bit weaker than I would have expected, so a little bit of downside surprise there. And the way that I've generally played it, I avoid oil futures. I've been not particularly bullish on oil futures, so I've avoided those. But I have been pretty constructive, and I've also avoided small caps. But I have been pretty constructive on the larger, safer plays, the producers, and as you mentioned, the midstream. And those have held up better, generally speaking, than the underlying price or compared to the small caps. And going forward, there's a couple of dynamics here. One is, the global economy is kind of sluggish, and so that's keeping a lid on a lot of this. There's demographics issues. China's not booming at the moment. The U.S. is not booming at the moment. Europe's not booming at the moment, and other economies, can only move the needle so much, like India. Um, and so there has been a little bit of softer demand side, and then on the supply side, um, I don't view it as like a very large glut, but it's not been a shortage. Let's put it like that. There have been some offshore discoveries and growth there. Shale oil has not been growing much, but it's not it's not quickly rolling over. So there's no kind of acute issues. I think the issue going forward is that U.S. shale is roughly speaking, it's peaking. Um, and so basically the drilling gets less efficient now going forward, most likely. Depletion rates are faster. The current price levels don't really encourage new investment, expansion, and drilling into that super quickly. Um, and so my bullish case is own assets that have longer lived assets behind them, like offshore, potential oil sands, all these kind of longer lived assets, and let U.S. shale kind of gradually, not just it's not going to collapse, but just gradually diminish, tighten the market to some extent. Whenever you do get a spark of demand, I think that then you're pretty well positioned. I mean, many of these larger oil companies and pipeline companies do have decent balance sheets. They can wait out kind of a flattish market. They can invest less. They can just kind of batten down the hatches and get through it. And I think one of the catalysts, like we talked about before about the balance sheet, I think as we shift here toward balance sheet tightening to kind of structural balance sheet loosening, that can over time relieve tightness on the dollar, benefit emerging markets, and then over months, quarters, and years, demand I think can pick up. And at that point, you don't really have the offset of U.S. shale anymore. And so I think you want to be positioned for at like companies that have good kind of long-term oil and gas assets.
Hmm. Any thoughts on the Canadian sector, oil sector?
I mean, so during the whole kind of COVID bear market, I got quite bullish on the oil sands companies up in Canada. And that thesis is largely played out. I mean, they did pretty well, and they've also been paying dividends along the way. So I remain kind of long-term bullish, and for me, it's just a valuation and timing concern. So not as explosively bullish as I was back in 2020 or 2021, but long-term, that is one of the potential long-term sources. I think right now for me it's like offshore is perhaps the most interesting area to me in the market. But there are many pockets, and you just have to value them appropriately. You have to take into account obviously political risk for all these different jurisdictions, including Canada.
Yeah, yeah, for sure. I got a lot of friends. They're big into Transocean's stock, and it's been very volatile. And so I've been kind of opting for like a Noble Energy, Valaris, and some others. But yeah, appreciate you sharing that. So a lot of value in this discussion today. I appreciate your time, Lyn. Where can people connect with some of your work? Obviously, you're on X. You're growing. You're big time.
Yeah, people can check out lynalden.com for my research. They can see me on at Lyn Alden Contact on X. They can check out Broken Money, my book, on Amazon or elsewhere. And thanks for having me on. I appreciate the discussion.
Yes, indeed. And you all be sure to hit the subscribe button. If you haven't subscribed yet, click the link that's pinned in the comments. That is to the Vancouver Resource Investment Conference. I will be there live in person in Vancouver next month. So hope to see you there in person. And Lyn, appreciate you for coming on the show.